understand at what sales level or the activity level we will be able to break even, and at what point beyond which you will be able to make profit. So, for example, you have a fixed cost of so much per year in your organization for a product, and there is variable cost. And if you start selling, maybe if you just sell 5 units or 10 units, you might not be even be able to break even. So, if you go beyond, maybe sell 10,000 units, at that point you break even, and beyond that 10,000 point, if you sell 15,000, 20,000, there is a lot of profit that is created, and then you make money out of it. So what does this break-even point is something that is worth analyzing when we do costing, and this is going to help in driving the organization's costing better and reaching targets. So for this as well, there is an example which I would like to take. So let's focus mainly on this portion, best case alone, and then we will try to understand. So maximum capacity in this theater is 9,000 seats, and you can sell these tickets at 16 rupees per ticket, and you have a variable cost as more and more people come in. So for every person you are spending 10 rupees out of your pocket, and maybe to maintain this stadium and things like this, maybe you are spending so much of money irrespective of the number of people you come in. So this is the situation where you are in. Then if you are asked to calculate what is the break-even point in the sense how many tickets you have to sell in order to make sure that you are at least breaking even the expenditures that you are incurring. So for that, how to compute is fairly simple. So there is something called contribution per unit. So what is contribution is basically on the selling price, you take out all your variable costs. So that difference is called contribution cost. And this contribution cost, if you divide it with the fixed cost that you have, 48,000 divided by 6, you're going to get 8,000 units. So this is the break even. So at least 8,000 tickets you will have to sell in order to break even. And anything beyond, if you sell, then you're going to make a margin of 16,000, which is profitable. So just to repeat it again, in any scenario, if you want to understand what is your break even point, you just have to understand what is the contribution and divide the fixed cost that you have by contribution. And how do you calculate contribution is basically subtract the variable cost from your selling cost, then you get contribution, and this contribution divided by the fixed cost, you get the break even point. So any questions on this? Or anybody wish to add anything? Okay, I assume no. So let's take case A. In case A, what has happened is, apart from break even, we want to generate a profit of 3,600 rupees, for example. In that case, how do we go about? So a simple approach is, if you want to make this profit, consider this also as fixed cost, add this, and then divide that by 6. For example, that 48,000 plus 3,600 divided by 6 will be your break even point. And then break even point is what you will have to, beyond that you will have to get this value. So it is going to be, okay, 1 second, I think I did some mistake here. So it's going to be 48,000 plus 3600, then divided by 6. So if you have to sell 8,600 units, 8,600 tickets to make a profit of 3,600. I hope it was clear or easy to understand how I got this number. Or do you want me to repeat?
Repeat once, Akash.
Sure. So in this case, let's see, if you want to break even, then it is 48,000 divided by your contribution, which is 6. So you sell 8,000, you will be able to break even. If you want to make more profit, right? If you have 48,000 plus 3,600 if you add. So if you want to have a target of 3,600 as profit, just add 48,000 plus 3600, and then divide this by contribution, which is 6. You are going to get, sorry, I think I added one extra 0 here. So it will be 8,600. Let me do it again.
What does contribution mean actually?
Uh, what does contribution mean is, in the selling price that you are selling, how much is your fixed cost contributing? Okay, to give a better example, maybe in an organization, if you have a fixed salary, then irrespective of the number of products or number of deliveries that you make in your product, the fixed cost or salary is going to be the same. So the more you deliver, the more profitable you get, because your cost is not going to change. So from your fixed cost that you have, what is the contribution for the sale that you are making? So simply subtract your selling price by variable cost, you get 6 rupees. So this is the contribution that has come from the fixed cost. So in order to break even, if you want to see the number, just divide the fixed cost by contribution, you get 8,000.
Okay.
So on similar lines, if you want to generate profit, right, simply add the profit that you want to generate to the fixed cost that you have, then divided by contribution, you will get to know how many tickets you will have to sell. And in case if your fixed cost is increasing, then in order to break even, you cannot sell some 8,000, you will have to sell 8,200. How did I get this? Is basically 49200 divided by 6. So because your fixed cost has gone up now from the original value, you have to sell more tickets to break even. On similar lines, if you have got some free money, donations from somebody, then your fixed cost is going to come down, right? So in this case, if you have to break even, then you have to only sell 7,000 tickets. Okay, I hope the flow was easier to understand. There's a good example to understand how break-even point changes with fixed and variable cost. Or somebody want me to repeat? Okay.
Could you repeat the question, please?
Sure. So fixed cost divided by contribution is going to give you the break-even point. So 48,000 by 6 is going to get you this. If you want to generate a profit, right, then add that profit to your fixed cost and then divide it by contribution, you are going to understand how many tickets you have to sell. On similar lines, if you have an increase in the fixed cost, for example, last year your fixed cost was this much. So even if you sell 8,000 tickets, you are able to manage with it. But today, this year, the cost has gone up for you. In that case, you cannot sell the same 8,000 tickets and make the same or break even. You have to now sell 8,200. How did I get that? Is fixed cost, which is revised, divided by the contribution. So I got 8,200. On similar lines, fixed cost might also come down. For example, if you got some donations, which is free money for you. So you can subtract that. So this fixed cost has come down for you. In this case, if you have to break even, you just have to sell 7,000 tickets. On similar lines, if your variable cost goes up, then your contribution gets updated, because your contribution is basically a subtraction of your selling price and variable cost. So your contribution is now 5. So in this case, if you have to break even, then it is 48,000 divided by 5. So you have to sell 9,600 tickets, which is not possible because you have only 9,000 tickets. So if your variable cost goes up, irrespective of whether you are forceful or not, you are not going to make money. So what you can do is you can increase the selling price. So let's see what happens. Instead of 16, you increase the selling price to 18. In this case, your contribution is 8, and then you divide 48,000 by 8, you are going to get 6,000 tickets. If you sell 6,000, it is sufficient. So all that you have to try to understand is, if you have to calculate the break-even point, just understand the fixed cost, just understand the contribution, take a ratio of it, you get to know the break-even point. And if you want to make profit, add this profit, target profit to your fixed cost, and then divide it by the contribution, then you will be able to understand how many products you have to sell. In some case, if you end up in a stage where you have more tickets to sell but you have limited seats, then you have to update your pricing. You don't have a choice to even break even. Hope it is clear. Okay, if so, then there is a follow-up exercise where there is some additional inputs given to again calculate the EBIT and target profits. Maybe you can go through. I will share this, but it's fairly easier. Now there is an introduction of something called operating leverage. So operating leverage is basically you have seen this behavior. So because of this fixed cost, which has been constant, the more you sell, the more profit you make. Because this is constant, so you have a leverage there. So your contribution, so your operating leverage is basically the contribution divided by EBIT. Let's take this example. So here your sales is 1000 and your variable cost is 400. Your fixed cost is 350. Your contribution in this case is sale minus variable cost, which is 600. And your earnings is, how much is your earning? Out of the sales, you take out the variable cost, you take the fixed cost, you're going to get 250. So this is your EBIT. If your variable cost is the same, but if your fixed cost decreases, then your profit also decreases. If your fixed cost increases, so here contribution is, operating leverage is 4x. So basically, if you sell more when you have a fixed cost which is constant, if you sell more, you're going to make more money. If you sell 2 times, you make 2 times the money. If you are on the other hand, if your sales falls by 2 times, then your profit will also fall by 2 times. So this is called the operating leverage. So how fixed cost will play a role in the profit?
Kash, can you please repeat one?
Okay, sure. So what is happening here is, in this case, if you see this example, here your operating leverage is 2.4. How did I get 2.4? It is basically contribution divided by EBIT. Here your operating leverage is 1.5. Here your operating leverage is 4x. What does this mean is, if I have an operating leverage of 2.4x, if I increase my sales by 10%, then my profit is going to increase by 24%. On similar lines, this as well. The other side is also true. If my profit decreases by 10%, if my sales decrease by 10%, my EBIT will also fall by 24%. So this is a leverage that you have. So having the fixed cost behavior, which has been constant irrespective of the units that you sell, if you sell more, you can make more money. If your sales drop, then this is going to eat up your money, and then you have lesser profits. So if you want to wisely play, then have a fixed cost, and with fixed cost being there, you try to utilize your capacity to the maximum and have this leverage in place where if you sell more, your EBIT will increase proportionally, or 2 times 10% increase here will increase your EBIT by 24%.
Yeah, is the best. Thanks.
Yeah. So okay. So these are some equations, but I think let's get into a problem and then try to understand. So here in this problem, so there are 2 stages where when this there are 2 options, either to go with computer assisted manufacturing or labor intensive. So they want to develop a product, and if they can either use labor manually do this product, or they can use a robot or computer control device and manufacture. In this case, what they have observed is, if they use this option, then their material cost is going to be $5, and their labor cost is going to be 6, and their variable overheads is going to be 3, and they have a fixed overhead of so and so. In here, similar things are playing out. Now, the question is, what is the break-even point for this and this? So to calculate the break-even point, so all that is written here, right? I've summarized it here. So your total fixed cost is going to be this, plus there are some instructions here for selling and so many things. They have spent a lot of money. So in computer case, they have a fixed cost of this. In labor case, they have a fixed cost of this. And selling price is this. And there are so many variable costs involved. So total variable cost is basically a sum of all of these. Then if you want to see the contribution, in the selling price, you take out variable cost, you are going to get this. Now, if you want to understand what is the break-even point, you divide this number by this number, you are going to get the break-even point. This is here. In the labor case, you again do the same thing. To understand what is your contribution, and you divide this by this, you are going to get your break-even point. So, if you use computer, you need to at least produce and sell 2,10,000 units to break even. But in the case of labor, you can only produce 1.75 lakhs and still be break even. So which is good in this case? It depends on the market conditions and the situation in which the organization is. If they are confident that they can sell more, then they can go with this solution. But if they are not so confident that they can sell so many, then they can be conservative and decide to use a labor as an option and try to at least sell these many to break even, and beyond which if they produce something, they can make money. So this break even point here is clear. Anybody want to add anything more? Okay. So on similar lines, if you once you get this break even point, there is a follow-up question which says, at what activity level both of them mean the same? For example, in this case also you should make same profit. In this case also you should make same profit. What is that activity level? That is the question. So EBIT is basically the operating leverage multiplied by contribution multiplied by the sales unit minus the fixed cost. You equate both of them, then you're going to get a value of 31111. If you produce this many, it is indifferent. Either you use computer or labor, then it's going to mean the same. So where have I written it here? Here is the equation. So EBIT is basically contribution ratio multiplied by sales minus fixed cost. So the question is asking what is the activity level at which either computer or labor intensive production means the same. So you just have to put the same things on both left hand side and right hand side, and for this you have to put the contribution cost of computer, and on the right hand side you should do the same for labor, and solve for sales. Then you are going to get this value of 3111. And to calculate operating leverage for computer, for labor, I mean, it's the same formula that you'll have to use and get this. So maybe the rest of them I'm not going through in the interest of time, but you can go through. Any questions on this, how to calculate the break-even point and see where both of them have same meaning or same effect on us, and how to calculate operating leverage? Okay, I assume no. Okay, this is going to be, I think, too much for today. There are two case studies which are used to understand, basically here, there is one decision making, right? So how can costing help us in decision making? There is an example basically where it says they wanted to check whether outsourcing makes sense or producing it in-house makes sense. So in that case, each cost item was considered, and there was a computation made as to which one would cost how much, whether they produce it in-house, what would it cost, and if they outsource, what it would cost. And if you sum up and see, then it came out that if you produce it in-house, it's going to be cheaper. So the organization can take a call that they can produce it in-house. So this problem is the gist of, I said the gist of this problem, but you can also go through and understand this. And this is an interesting case study. Maybe we can touch upon this. So in this case, what has happened is, let me give you the background. So it's a small organization which is producing valves, pumps and flow controls. So the objective is that they want to understand why their overall margins are declining, and they want to come up with a solution to maximize their profit. And they have found some observations that their observations are they have used simply for simplicity volume based costing, which we have studied so far, and they felt that some products are doing okay and some are not doing okay. So how do they solve this problem is the question. So if you see the cost structure of this company, overall, all three products together, valves, pumps and flow controls, they have sold so much. And previous year they have a labor expense of so and so, material expense of so and so, and there are a lot of overheads that have come. So mission related expenses, setup related expenses, and receiving and production controls, engineering, so many have come. So all of this come up to 806,000. And if you subtract total sales from, I mean this and this from total sales, you are left with a gross margin. And then on top of that, they have some admin cost XYZ. If you take that out, their operating income pre-tax is 57,600. So this is a typical scenario. If this is clear, we can understand more in the subsequent sheets. So is this clear? This is a reference given to us. We have to understand now why it is not profitable. How can we make it? I mean, how can we make the profit in profit maximization is what we want to try. So key observation here is, if you see overheads, total manufacturing overheads is actually 3 times roughly the direct labor. It's a labor intensive organization. Cost driver is labor. So here, if you divide this overhead by this, you get roughly 3 times. So 300% is the overhead. So this is what is given to you. Now, if you also see their cost structures, right? For producing every valve, they are expending 10 rupees as direct labor, 16 rupees as material, and they have a manufacturing overhead of 300%. So basically 10 is the direct labor, then multiplied by 3, this is the overhead they are applying, and their unit cost is 56 is what they are assessing. And they have a target selling price of 86.5 because they want to make 35% margin. So if they are selling it at this price, and so they wanted to sell at this price, but because of market dynamics, if they price it at this price, it is not getting sold. So they end up selling at a lower price, which is 86, very less. But in the case of pumps, right, they want, if they have to reach a target of 35%, then they have to sell it at 107.69. But market, there are a lot of competitors who can only sell, who are forcing them to sell at a lower price of 87. In this case, they are only making a margin of 19%. In case of flow control also, the situation is pretty much this, but they see an opportunity even if they increase this price, right? So they want to target it as 95, but even if they increase, it is going good. So their observation is that because of heavy competition, they are not able to price this product and make margin. But in this case, even if they increase, they are okay and they are managing. So if we don't do proper costing, if we just go by the rational, we say okay, this product maybe is too much competent in the market. This has an opportunity. Let's increase this price and let's try to maximize profit. And here, let's see what to do. But if you do breakdown of these activities inside, and then if you realistically understand what is happening, then it makes more sense. For example, uh, what has happened is these costs, right? These costs, here if you see, we are simply applying the 300% overheads. So 3 times this. But actually what is happening is, if you go look at the activities, then the portion of activity, for example here, right, the portion of activity for flow control is lesser, the portion of activity for valves is less higher. So it's varying. So we cannot simply do a direct 300 multiplication on the direct labor to add overheads. In this case, it makes sense if there is so much of difference here, we do an activity based costing. So we split this cost. First, we understand what portion of the activity who is consuming. Here it is like, for example, if you look at these three, if you infer from these two, you will get to know that machining related, it is costing $30 per hour, and the setup labor, etc., is costing $250 per run. So you have to from these two tables and jot this down. And then if you do a proper costing, for example, based on the activity utilization of these products, then you get a whole different picture. If you see here, the standard unit cost of production is 46.64, but here if you do a rough costing, you had 86.15, so it's a problem. So actually you are spending less, but you are targeting more. On the other hand, if you see valves, it is 115 that you are actually costing. But if you do rough costing as you did before, you thought that you are able to produce it at $62, but it is not the case. You are actually producing it at 115.38. So after looking at this activity-based costing split up, then you understand that you are still making profit here, and here you are actually making a loss. So you have to see whether in this you can sell it at on top of this, if you multiply with 35% and see what the value comes up to, and if you can still sell it in the market, fine, or else they can consider discontinuing this product, and this is actually doing good for them, and they can go about, and if they do all of these, then this final profit and loss statement for them will look much better, and they will be able to reach a target. So the gist of this problem is you cannot always go by overhead application. If there is multiple products which has multiple activities inside which are very different, then you have to divide this into multiple chunks, understand what portion is used by which product, and then apply rates accordingly, and that get a realistic value for your product costing, and then plan it out accordingly. So I'm going to share these notes for you, but this is the summary. And this is master budget and standard costing and variance analysis. So maybe I'm not going to touch this, but it's going to be more theoretical, but you to understand. If you know costing, then these two is going to be very simple. So yeah, I think the last two problems I split it up a bit because I think there is a shortage of time. We only have 4 minutes, but yeah, if you want more, you can ping me anytime. If you have any questions on this, I can also help you out. But yeah, for today, if there are any questions, we could speak. If anybody want to add anything, we could speak about it.
Nothing from my side, Akash.
Okay.
Thanks, Akash. That was
Yeah, no problem.
really like we follow.
Okay, if there are no questions, then what I would do is I will share this Excel sheet that I made for understanding, and I would also share these notes, and yeah, please go through, and if you have any corrections, if there is something wrong, please bring it to my notice. I will correct it and reshare with all. And if you want me to add something, yeah, please let me know. I will add it and share it.
Yeah, thank you, Akash. Thanks, Akash.
Thanks.
Thanks, Akash.
Thank you. Yeah, bye. Take care.
Thanks, Akash. Bye. चलो